call, but we're just now starting the YouTube, Facebook live stream. I'm Bill Gross. This is Daniel Arias, and this is our Tuesday LA Real Estate Investors podcast. And we're kind of midstream here. And Daniel introduced himself. And if you missed that, I'm sorry, my bad on not getting the live stream. If you're watching this, though, on YouTube or Facebook Live or LinkedIn, feel free to put questions in the chat box, participate. If you're watching a recording, put questions there. I'll get back to you. If you're on the Zoom call, this is meant to be participative. This is the LA County Real Estate Investors Association live podcast. We do this every Tuesday at 3 p.m. Pacific, 6 p.m. Eastern time. And this is affiliated with the meeting we do once a month in the West LA area of Culver City at the Iman Center. The next meeting will be the second Thursday in May, which is May 11th. And there's a vendors expo with a bunch of vendors there. It's going to be ladies, women who rock real estate will be the topic. So we do this call every Tuesday at 3 p.m. And then we have the program live second Thursday every month in Los Angeles. Love to have you join us there. So Daniel, give me an idea. I mean, every loan I talk to does all kinds of loans, but what's the most common, if I just say to you, what's the one loan, when you get that, you go, we do those all the time. What are the one or maybe two of those that are most common in your business for you?
I mean, that's the beauty of what's gone on the last 2 or 3 years. I think through product innovation, we've really expanded our services and we've been able to help virtually any borrower in any scenario. And I think that's one of the great things that's come out of the pandemic is that there's been a great appetite to continue expanding product. And so, there's stuff like 3-2-1 buy downs that have been very popular with graduated payments. They've been around for a long time, but when rates were at 3%, you can't do a 3-2-1 buy down because we can't give you a 0% loan for the first year. But with rates at 6 or 7%, these graduated payment loans have become very popular. There's also been the expansion of the DSCR loan, the debt service coverage ratio loan. That's very popular for investment purchases. There's been a complete revamping of the private money space as well, which is also risen to one of the top products in the investment space as well. So, everybody can do a conventional loan, anybody can do a jumbo loan, but I think our platform allows us to really help the self-employed borrower, the investor, or the person that's buying their first condo for $400,000 in San Dimas. And so, if there's still $400,000 condos in San Dimas, but
I don't think so.
I think our platform does have the ability to service almost any client. I don't think I would have pigeonhole ourselves into one specific product or one specific niche. We do, like I said earlier, we do work a lot with borrowers in the entertainment industry, as they do get paid in a very unique way. They're gig workers, usually jumping from commercial to commercial or show to show. They go on hiatus for a few months of the year, and so it's a very unique way those people get paid. And most lenders don't understand or don't know how to underwrite those files, and we do a really, really good job of understanding that type of borrower.
When I started in business out of college, one of the greatest business books ever written, which is called In Search of Excellence, evaluated the best companies in America at that time. This is before you were born, I think, Daniel. And most of the companies it said was because they specialized in one or two things. Back then, they used the example of McDonald's, because in those days, McDonald's only offered hamburgers, cheeseburgers, filet of fish, fries, and drinks. That was it. And they said that was especially, well, you go to McDonald's now, they have, I haven't eaten there because I keep kosher, but I've been there for coffee, and they have breakfast and lunch and dinner and all kinds of stuff. I think every business has had to branch out. I know in real estate, I do probate real estate, but I've had to add commercial, industrial, retail to the mix as my customers come to me and I can service them. It sounds like you do the same thing in your mortgage business. The challenge is keeping up on all those products and having lines to send them to. How do you manage kind of learning about all the different product types that come out, since you have a broader array, and as well the companies that send your product to get funded?
Yeah, that's a great question, because it's not easy staying in touch and staying informed on every single product that we offer. If I showed you our product guideline and our product hub, I want to say there's probably close to 70 different products that we can stick different borrowers in. And so, everything again from conventional VA government loans to FHA, conventional jumbo, ARMs, DSCR, private investor label stuff. So there's just a myriad of different products, and you definitely have to know your guidelines. You have to be able to know which investor is going to be the best fit for that specific borrower. You may think that it may be this specific investor, but there may be one thing that the borrower doesn't have. Maybe they don't have the 12-month rental history that one investor is looking for, and then you can't put them in that specific credit box. And so just knowing and really staying on top of guidelines, reading them over and over and over. When a new product comes out, we usually on our team, we usually assign it to somebody on our team to kind of study it and then share with everybody else and kind of do a little bit of a case study on the highlights of that different product. But that is one of the challenges, is that as new product comes out, staying on top of it, knowing when to utilize and how to leverage it is important, but it's also challenging because it's that shiny object syndrome that something else new comes out, you get excited and you got to go learn that, and then maybe you forgot about the last product that they just launched. But I think it's good because this is also going to allow the true mortgage advisor to shine. I think this is going to be the time for that mortgage advisor that knows guidelines, that knows how to advise a client, that can tell a client not just what's going on in today's market, but also kind of project forward and figure out what's likely to happen in the future based on data, based on the economic, all of the economists that we follow, and really inform a borrower so that they can make an educated decision. And so I think we do a really good job of, again, not just telling the story of what's going on today, but what's likely to happen in the future as well.
So how do you personally keep up with it? I mean, you must have guideline changes every minute with that many programs and investors. How do you allocate a certain part of your day or week to reviewing programs and products? Or how do you manage just the information flow of all that information coming through? Oh, can you hear me?
Bill, sorry, I may have lost you for a few seconds. Can you repeat that last question?
Yeah, I just said, how do you personally manage that? I mean, you must have guideline changes every minute, investor changes, company procedure changes, your own office company or greater New American funding procedures. Like, how do you just manage the flow of info? Do you have a schedule of time that you do daily, weekly? How do you keep up with it all?
Yeah, very, very carefully. Our company does a really good job of keeping us informed. They send out underwriting product updates weekly, letting us know if there's been changes. The one thing changes often is loan to values, right? We saw, for example, in the non-QM space with bank statement loans for the self-employed borrower, most people were doing those up to 90% LTV with 10% down. And as the market started to shift a little bit in the last 12 months, we started seeing those LTVs come down a little bit. So knowing that a particular investor will go to 90%, they're going to only go to 85 or 80 is really, really important. Yeah. And so just the flow of information is coming at a very rapid pace, but studying it, knowing when a lot of times they're not even the guideline changes don't take effect immediately, right? They're effective with locks on a particular date and moving forward. So it is a lot of information that you have to intake, but I think we do a good job of processing it and making sure our clients in the right loan products.
Shout out to Carl Sussman, who's visiting on the LinkedIn. Nice to see you, Carl. He was our guest on our Probate Weekly last week and a great asset in insurance. If you're watching on the live stream, either Facebook or YouTube or LinkedIn, feel free to jump in chat box. And if you're watching on the Zoom call, it's meant to be participative. The more you participate, the more money you make. If I could just do a recording and place it, I would do that. We do this because we need to interact as human beings. We need to interact as colleagues. And so feel free to ask questions, either raise your hand or put in the chat box. There's no stupid questions. We deal at the LARIC event, the LA Real Estate Investors Club. We do, with brand new people, first-time investors. And I know Daniel, his organization does a great job with first-time home buyers and first-time home investors. That's why I have them on here. So feel free to ask questions and participate. We'd love to have your questions. So Daniel, let's talk first about first-time investors. Somebody who comes to you and says, I'm buying a home for the first time. It's a rental. We're going to buy we're going to move out of our house. We're buying a house. We're going to turn a house into rental. What do you see as the biggest challenge for a person going from not to being a first-time rental financially? Do they need to get their finances together? Do they need to get their taxes done differently? What do you see as the biggest challenge holding them back, or what advice would you give them to get them to move forward?
Yeah, before we dive into that, I think it's important to know what the GSEs, Fannie Mae and Freddie Mac, did last year for second investment actions, right? So Fannie Mae and Freddie Mac, the government-sponsored enterprises that back and insure 90% of this country's mortgage debt. back in March of last year, they decided that they were going to essentially tax on all second home purchases and investment purchase loans. And the reason they did that was they saw a surge in second home purchases and investment property purchases through COVID. I think a lot of the $11 trillion of money that was injected into our economy was being funneled to purchase homes. And so they wanted to make it just a little more difficult, a little more expensive for people to do that. And so they essentially added a tax through what are called LLPAs, loan level price adjusters. And they added anywhere between 100 to 300 basis points on certain transactions that were second home and investment property transactions. So as of April of last year, we really had to take a second look on how we were going to approach products for people who were looking to purchase investment properties. And money space has actually become oftentimes a better outlet for us because one, the barrier to entry is a lot lower just from a qualification standpoint.
Sorry, we lost you for just about 10 seconds there. What did you say is a better alternative?
Oh, the private money space is actually, the private money space has actually become a better outlet for investment purchase transactions for a couple of reasons. One, the barrier to entry is lower. You can get into a private money loan without having to show tax returns, and they're qualifying you more on the actual transaction and equity position itself than they are on your qualified documented income on your tax returns. And so we've seen that the private money space has actually become a better alternative than conventional money. Now, if you are putting a significant amount of money down, if you're doing 30, 40, 50% down, conventional money might actually net you a better interest rate. But as of last March or April, we did have to take the second look at how we approach investors and what products we offer, because that shift in pricing dramatically changed the rate on second home and investment property transactions. So, what I would tell any investor looking to break into the investment space is try to save up as much capital, try to have as much money down, especially in our local market here. I mean, if you're trying to get a property to cash flow here in Southern California, more often than not, you're needing to put down upwards of 30, 40, 50% just have a property maybe break even or cash flow a little bit. So save up as much money as you can and try to put the largest down payment that you can.
Yeah, that's the challenge is you're paying for the mortgage and then you're getting putting a large chunk of money down that you're not getting return for other than the whole property. And the larger your down payment, the more challenging the return is. So you have to look at those numbers and look at the options. The old school of just paying the minimum just doesn't make sense for so many cases today as investors. So let's talk about first-time home buyers. There's always in the press so much concern about home buyers. I always say it's just a shell game that the politicians play with us, because the obvious answer to helping more people buy more houses is to build more houses. If you build more, people can buy more. If you build more, the prices are affordable. We're not going to do that in California. So what do you say to first-time homebuyers who are struggling to get over the hump to that bar to get in the game? What's your best advice for them to get into the game?
Yeah, that's probably the one area of our market that's the most challenging is first-time homebuyers trying to just get their iron in the fire. And luckily, there are great products to support the first-time home buyer, whether it's the 3% down conventional loan or the 5% down conventional loan. There are products out there to allow clients to get into good loans with a good rate. PMI, private mortgage insurance, used to be a pretty nasty thorn in the side, but the PMI companies have gone to war with each other for the last 5 years, really bringing those.
Isn't it amazing? Isn't it amazing?
You can, it almost doesn't make sense to put 20% down, because you look at what the PMI factor might be on a 10% down loan, and the PMI factor might be $70 a month, but the client gets to keep $80,000 in their pocket. I'd rather keep $80,000 in my pocket and pay an extra $80 a month. So it doesn't make sense to do 20% down in many cases. But so we've seen PMI companies again bring their factors down. We see that these lower down payment options are lowering the barrier to entry, allowing people to get in. I think the biggest challenge right now is just the cost of funds and interest rates still being relatively elevated compared to what we saw in the pandemic levels. Now, I don't think they're going to go back to 2 or 3%. I do feel like there's some good news around the corner in regards to inflation and what rates will do after that inflation begins to come down. May 10th is a very, very significant date. I would highlight May 10th on your calendar. That date is going to give us the inflation report, the CPI report for April of 2023. And if you look at the CPI index, it's a 12-month rolling average, and the April 2023 number is replacing the April 2022 number, which was a very elevated number. And so we're going to likely see really good news on May 10th as it relates to inflation. And we should see rates begin to follow that trend as inflation begins to curb. And that's good and bad news, right? I think that's good news because rates will come down. The bad news is rates will come down. And I think everybody is waiting for rates to come down. We saw in January, actually January 7th, we saw a spike in activity with just a small drop in rates. We saw rates peak at the end of last year, October, November. And then we started seeing some good news on inflation towards the end of the year. And we saw rates follow that trend. And all of a sudden, in the beginning of January, pre-approval activity spiked. I think everybody felt it, right? We saw buyer activity, open house activity really, really increase. And what ended up happening is that on February's inflation CPI report, it missed the mark. I don't know if everybody caught that. It only went down 0.1%. They were hoping that the inflation report would show a 0.3% drop, and rates reversed course. And so we saw rates now start inching upward, and then you add the bank failures into the mix and all the fear that brought into the market. Now we're seeing rates back again, flirting with 6 and 7 again. So that's been the biggest challenge for first-time home buyers, is that still the cost of funds is relatively elevated to where we saw rates back in the pandemic levels. I think a rate in the 5s brings buyers back in a meaningful way. I think a rate with a 6 keeps people pondering, and a rate that starts with 7 keeps people running. So I'm hoping that, as the summer buying season heats up, that we will see rates come down and we'll see a meaningful return for of the buyers back into the market. But the other thing that we can talk about too is the inventory levels. Like, we're going to have a lot of buyers come back into the market, but good luck finding them any inventory to buy, because that's been just another unbelievable challenge that we deal with every single day. Our pre-approval activity is actually really, really strong right now. It's just there are no homes for these people to actually make offers on. If there are homes on the market, everything's in multiple offers being bid up significantly over the asking price again.
Well, there's a lot to unpack there. One, as you know, rates came down a little bit today, so we're kind of back on that. The lower half of 6s, stirring at 5s, perhaps. You're so right in the PMI. I remember the first time I did a PMI about 6 months ago. I hadn't done one for first-time home buyer in a couple of years. I thought, that can't be the right rate. Something's wrong. It's come down so much. I think that a lot of the old timers like me assume that extra charge to PMI is very expensive. But when you compare the cost of money today, you can buy treasury bonds with the $80,000 that you're saving, maybe on a 20% down in some cases. You're going to get money for that. To borrow it makes sense if you don't know where the economy is headed, because if rates go down, you've locked in, you can always relock in a lower rate. You haven't spent the money in the PMI. So definitely take a look at that PMI factor. Make sure that you're current. Even if you can afford to put down 30, 40%, take a look at what you might do with the money, even temporarily, as an option. A couple questions in the chat box. Again, reminder, if you're watching live on YouTube or Facebook, feel free to jump in there and post a question, and we'll get to it. So far, we have Carl Sussman saying hi. I did get a couple questions on the Zoom call. One is, does anybody know a good wholesaler-friendly title company who also has experience with creative finance? I don't know of any. That's Benny, that sounds like a question from somebody who's taken a program or seminar where they teach you what to do and then send you on your own. Anybody teaches you even the terms wholesale-friendly title company and experience with creative finance probably is doing business, because this is California. This is the largest market in the country. But I'm definitely interested in finding the answer to that question if you find somebody. Generally, if we say invest wholesale friendly, if you mean that they will not double close, that's one question versus double closing. I don't know if you're available online. I'd be glad to walk you through kind of some questions there, try to help you. If you want to reach out to me online, we could talk about it. More up Daniel's alley, what kind of loan do you advise for constructing a multifamily home? Do you do construction loans, and do you do multifamily loans?
Yeah, so we'll do multifamily up to 4 units. Anything over 4 units is considered commercial, and that's we don't do commercial loans here at We Fund LA. And as far as construction loans, those have been really hard to come by. Those require a ton of capital. Usually, you're seeing LTVs of maybe 50%, so it requires a ton of money. We get that question a lot. People they find an empty lot. First of all, they want to finance the lot purchase, which is again very difficult to do. Some
Right.
small credit unions will do those, but
Right.
there isn't a big appetite in the secondary market for construction loans, and we don't really do those here at a high level at We Fund LA.
Yeah, definitely the best source for construction is going to be a small independent credit union or local bank. That's what they do, and that's all they do. They're not going to do a 30-year fixed mortgage well. They'll do them and charge too much and not give good service. I used to make a living servicing small banks that didn't do mortgages very well. And you're right. Everybody loves construction until they find out what's involved. You typically have to buy the lot for cash. Then you can get a construction loan because it's about 50% loan to value. What you can't do is finance the lot and finance the construction. There's just no equity for the lender in those cases, and that's long behind us. There was a time you could do that, but those banks are now out of business, and those people are driving for Uber or dropping off DoorDash. I think they're not doing loans anymore. Okay, so let's talk a little bit about career advice, because some of the people on this call are either working a job 9 to 5, looking to get into real estate as an investor or as a business. We're starting out as in the business, wholesale investor type person, bird dogger. Obviously, you've made a living at this. You're doing this full time, but there was a time that you didn't. And you also have seen people like I do come to me all the time and say, how do I get started? What do you tell somebody who's looking to get started in real estate to kind of get over the hump of I'm not yet making money. Oh, now I'm making some money. How do they get over that hump?
Yeah, I mean, I think the first thing or the first piece of advice I'd give somebody is just to surround yourself with smarter people. Surround yourself with people that have done this more often at a higher level than you have. And don't be afraid to just take a back seat on a transaction or be a small silent investor just to get and gain that experience. One of the very first transactions I was ever involved in, I think I might have given, it was under $50,000 that I had contributed to a transaction, but that bought me a front row seat to just being a spectator on the entire process from acquisition all the way through resale. It was actually a flip that I was involved in. And then, from there, I was a slightly larger partner in another one. And now, I'm able to now raise capital myself and put together capital for doing large scale flips as well. So I think the best advice is just surround yourself with people that have done it more often and that do it at a high level and that, are willing to mentor you and show you the way, because there's definitely people that are way smarter than I am, and I just try to gravitate to those people, and I'm okay taking that back seat in exchange for that experience, in exchange for that front row seat, so that I can hopefully learn something along the way as well.
Such great advice. I think so often people start and they're so concerned on what they get out of it, what their commission rate is. I always see real estate agents who are new licensees, a little spreadsheet, and they want to see, I get who gives me the highest commission and the lowest fees. And the answer is going to be the company's going to give you the least, because if you're not giving them anything, how can they afford to give anything to you? When you start out, you hit it right in the head. Find some great, successful people and learn what they do and learn how to do what they do. And I know you did that with Mickey. I did that with my brother. It's interesting. My brother and Mickey and I think Mickey's friend Coca, they all started the lending business. I started my brother a couple years after he did, even though I'm the older brother. But, you learn from somebody who's really a legend in the business. You learn good fundamentals. You learn good systems, even though the business has changed 180 degrees. Because you have the fundamentals, you can apply them. And rather than pay tuition to go to college, you get paid something, even as minimum wage. It's something.
And I looked at it. Yeah, I almost looked at it as a paid internship. If you apply it to what I did on the mortgage side, I remember coming into mortgage as, just again, doing just entry level work, right? I wasn't I didn't thrust myself right into originations, and I saw it as really a paid internship. I was actually getting paid a small amount of money to just learn the business and be able to have that front row seats on how to process, underwrite, and really know that the foundation of what it is to be a good mortgage advisor. And so That's what I tell everybody trying to get into real estate or mortgage. Attach yourself to a really good team, find the most successful person in your area, offer to work for them for free, or that you want to shadow them, and just learn as much as you can. Be that sponge and really figure out too if it's the right career. Right. This is a very, very challenging business. We're probably working in one of the most challenging times I've ever worked in mortgage. Yet I actually think, even though as challenging as it is, I think it's actually an unbelievable opportunity for growth as well right now. So I'm actually really excited about this market because it's going to give our team the ability to grow our market share. I told all my team, don't look at your pipeline and get discouraged. Your success shouldn't be predicated on the size of your pipeline. It should be based on the size of your growth of your market share. How many of the capturable deals out there are you actually involved in? And so even though our volume may be down just because of market conditions, right? That's a systemic market condition that we can't control, but just be more focused on actual market share than you are on volume.
Well, I do like the idea of interning. And I always tell people, if you don't have something in mind, get any job you can in the industry. If they're going to pay you minimum wage to answer the phones at a good real estate office, they're paying you money. Just pay attention while you're there. Just while you're there, ask questions, learn, do more than they require of you. They'll promote you up. You started in that way. I know it's to some degree I did too. That's how I got into management, owning my own business. Was I was a sales manager, then a branch manager, and then the company went out of business. They said, hey, if you want to take over the office, you just pay the leases on the equipment and the property, and you could take over the business. And I got put in business because the right place at the right time. But I'd worked hard to learn before. So I always tell people, you just find something and get to work and learn the business. And then the things, good things will happen to you if you do that. Okay, last pass for questions on the live chat or the Zoom call. Feel free to reach in. I just want to real quick again promote. This is the LA County Real Estate Investor Association live podcast. We do this every Tuesday, 3 p.m. Pacific, 6 p.m. Eastern Time. We live stream on YouTube and Facebook. Daniel's company, our guest today, Daniel Arias, is from We Fund LA, and you can go to wefundla.net to get in touch with his team. There's a phone number. There's a Let's Talk button. That's always impressive. All kinds of info and cute pictures and all over Los Angeles. So feel free to join him there. And so appreciate having him. The meeting we do is not going to happen next Thursday. Normally it's the second Thursday of the month. It's canceled because of Ramadan, as our hosts at the Iman Center. It'll be the following week, following month, May 11th. And there'll be Meet Women Who Rock in Real Estate. A couple of my favorites, Jen Maldonado has been a guest on this show, as has Deborah Razzo. So feel free to join us weekly. And then on May 11th, go there. Daniel, tell me a little bit about, I know that you do the California Dream for All, the Cal HAFA program. Do you want to describe that a little bit for us?
Sure. I'm laughing because I just saw this funny meme about, every mortgage advisor getting 1,000 questions about that program, right?
And nobody asked you. I kept waiting the whole time for somebody to ask the question. I have the website teed up for when they ask the question. Nobody did. So I'm going to ask it. I know people want to know about it. So tell me about it.
Daniel, tell me, I heard there's free money from the state of California. They're
exactly
20% down, right?
Exactly.
Yeah, unfortunately, there's a lot of caveats. There's a lot of strings attached to that program. I think at first estimates, maybe 2,500 to 3,000 families will be able to take advantage based on the allocation of funds. I think it was 300 million that the state allocated. And so maybe 2,500 to 3,000 families might be able to use that program. But I think the biggest thing that stood out to me was just the equity share portion of that contract that you have to sign. And you're basically inviting the state to be an equity partner with you in that purchase of that piece of real estate, which again, for some people that might be okay. I personally wouldn't want anybody else to be a partner with me, especially if it's the state of California on a purchase of a piece of real estate. So for me, I don't know if it's the right program for me, but there are a lot of the other little gotchas. There's some income limits as well, that if you make more than $180,000 in LA County, then you can't qualify for the program. I think, again, it's good for certain scenarios. If you're going to hold the house long term, if you're going to be in that home, I would say a minimum of 7 to 10 years, you probably have enough time to build up equity so that you're never caught in a position where you could potentially be upside down on a sale. If you get into this program and in 2 or 3 years you need to sell for X, Y, and Z reason, you may not have enough equity to even cover the commissions that you may need to pay on liquidating that house or selling that house. And so you may be paying out of pocket at the end of the day if you take on this 20% grant from the state. So again, I think if you're going to hold long-term and you fit all of the very specific credit box that they're looking for, it's a great program. The other one thing that I think is also going to be a big deterrent is these programs typically take 45 to 60 days to close. There's multiple layers of underwriting. You got to send it to the state. So CalHFA can actually underwrite the file in addition to the lender underwriting the file. And I don't know about you, Bill, but in this current market as of today, it's all about speed and efficiency. I don't see many listing agents wanting to wait around 45 or 60 days for an escrow to close. Again, some scenarios may allow for that, and there may be some transactions, some sellers that will allow for that longer closing period, but 90+% of the transactions we're involved with, they're escrows that are under 21 days or 14 days in many cases. So unfortunately, I think there was a lot more bark than bite to that product or to that program. But
hold on. Do you think the state of California politicians create a program they could talk about, but didn't actually help the citizens of California buy more houses? Is that what you think happened here?
That would never happen, Bill. Come on.
I just want to check you there, make sure we didn't get into the politics of that. No, you're absolutely right. 10 people end up buying these houses. 2 million will call the loan officer and ask about it. And I think it's, generally speaking, it's probably not for but a very small group of people. A lot of people ask questions about it. It is an interesting product. I would argue the opposite with you, though, as far as the equity. I would say to a home buyer, if you're a first-time home buyer and you put no money down, it's a safe way to buy in that if houses go down in value, it's easy to get out of a loan, a foreclosure, if it's a purchase loan and you don't lose any money on it. I think that we were trained to think that's a bad thing, but in reality, you see, huge companies, major banks, Great Western Bank, where I used to work, or you mentioned, I think Washington Mutual, they went bankrupt. There's no shame on that. So I would say that to me, if you're struggling to get in, and if you can qualify, and if you find a seller who'll wait, whoever knows how long it is to get the loan, it could be a good opportunity to put no money down because it protects you on the downside. You could always, it's not good to have a foreclosure, but it's certainly better that than losing a 20% investment, I think, of actual cash. We can disagree on that a little bit. Joyce has her hand up. Joyce, let's bring you in here. It wouldn't be a Zoom call without Joyce this week. What's going on?
Hey, Joyce.
Hi there, Daniel. Can I go back to my question a little earlier?
Sure.
I have a client that needs a buy before sell loan, and his current property that he lives in is a condo. Is it possible to find a buy before sell loan if the home that you're selling is a condo?
So are you talking about like a bridge loan product where the borrower would like to make his next purchase before selling his existing condo?
Right.
Yeah, so there are a couple of ways to solve for that. Whether it's a bridge loan where they cross-collateralize the next purchase and the existing home and gives the borrower X amount of days, maybe 90 days to sell the condo and then satisfy that lien. And then the other probably even easier way to do, because those cross-collateralization loans, again, going back to what I was saying earlier, those could take about 45 to 60 days to execute as well. So longer closing periods, you might be at a disadvantage trying to make an offer on the next purchase if there are multiple offers on that home. And so you want to try to make yourself as attractive as possible and lower your contingency periods as much as possible. Depending on your client's equity position, maybe tapping into a quick home equity line of credit might be a better option. That serves as another quasi bridge product. You're bridging yourself essentially by taking and tapping a home equity line of credit to free up some capital and put a down payment on the next purchase. Or depending again on the client's liquid capital position, if they have funds in savings that they can go and make their next purchase, albeit maybe not what they're going to net from the sale of the condo, but even if they have just a little bit of cash, a 5% down payment to make their next purchase, they might be able to do that without having to sell the condo. So there are multiple ways to solve for that scenario. It will depend on exactly what the borrower or that client's credit, income, and asset profile looks like. But there are multiple ways to solve for that.
Thank you.
You're welcome.
I think the best step always is give a phone call to a professional, ask for help individually, where you can go into details of your situation. So Joyce, I'm sure Daniel would love to chat with you individually on that as well, or your client, okay?
Thank you. Thank you.
Thanks, Joyce. Always great to see you. Send her back to the OC. Okay, so no more questions. Great. I'm glad we're all caught up. Daniel, thank you so much for being on today. I appreciate working with you. I met Daniel on the Robert Hall and Associates annual real estate conference call. We were both panelists on that. And I've known of his company for quite a while. I've done business with New American since they started as a company. And I've heard of Daniel and his team, but it was really great to get a chance to meet him then, and great to get you and meet you more detail. Now, Daniel, thank you for your time today. I really appreciate it.
Bill, thank you for having me. It's always a pleasure. Thank you.
And just again, if you're interested in meeting up with Daniel, you can go to his website, which is wefundla.net. I think I made the mistake of the .com about 50 times. wefundla.net has the phone number on there, has a Let's Talk button, has all kinds of great content and information about real estate and ways to meet him and his team. So thanks again. And for the rest of you, thank you for being on today. This is the LA County Real Estate Investor Association weekly podcast every Tuesday, 3 p.m. Pacific, 6 p.m. Eastern. We live stream it on YouTube, Facebook, and LinkedIn. If you're watching this call on recording, put your questions. I'll monitor those questions, either route to Daniel or answer for you as appropriate. Thank you for participating, Joyce, and the others who participate. Thank you for your questions. It's meant to be participative, and hope you guys have a great week. We'll talk soon.
Thank you, guys. Take care.